Hey, thanks for joining. In this video, I'm going to show you how to sell covered call options in your portfolio to supercharge your returns. Okay, so this strategy of selling covered calls is actually a very conservative strategy that you can use in your brokerage account when you own either ETFs or stocks, and it can be used to increase the return on your investments. Now, the options market is a very complicated market. There's a lot of different strategies that you can use. This is probably the most conservative way to use options, and that's what we're going to be talking about in this video. Now, what is a call option? Okay, there's two types of options. There are call options and there are put options. A call option is a contract whereby if you're writing the contract or selling the call, you are agreeing contractually to sell those shares represented by that contract or those contracts to the options holder at a specified price. In the case of a put, you're agreeing to buy those shares at a specified price. Now, what's the difference between buying an option and selling an option? Okay, most of you are probably familiar with buying an option. Options are traded like stocks or anything else. You can buy them on the options exchange, and you can go what's called long the option. Either bet that the price is going up in the case of buying a call option, and in the case of buying a put option, you're betting that the underlying security will go down. This way of playing the options market is probably the most risky because you only have a defined period of time to be right on the trade. And as we all know, frequently the market doesn't cooperate with us. So as a result, most long option traders actually end up losing money because the fact is 65 to 80% of options expire worthless. So because of that, I find that a much higher probability way of trading options is to sell options. Now, there's two ways you can do that. One way is covered options, where you own an equivalent amount of the underlying stock that's represented by the contract, or you can sell naked options. Selling covered options is a conservative strategy. Selling naked options is a much more risky strategy, and we're not going to talk about that in this video. We're just talking about selling call options against stock that you already own in your brokerage account. Now, there's some terminology that you have to be familiar with in order to understand this strategy, so let's get into that right now. First of all, let's take a look at the components of value within the options price, otherwise known as the premium. There are two basic components of value or premium related to options. One is the intrinsic value, and the other is the extrinsic value. The intrinsic value represents the value of the option when the price of the underlying security is greater than the strike price, or the price at which the option can be exercised. When the value of the underlying security is less than the strike price, there is no intrinsic value in the option. Extrinsic value, on the other hand, has two components. One is the time value, or theta, which is merely the time from today to the expiration date. And the second component of extrinsic value is implied volatility. And that relates to the amount of volatility in the options market at the time. And incidentally, just as a side note, right now, the VIX, which is a measure of options volatility, is currently very low. It's around 15. High would be considered, 35, 40. Right now, it's very low, so it's important to understand this in the context of this video, that right now, option premiums are relatively low, but we'll get into that a little bit more later in the video. Now, as I said earlier, what we're doing is we're not going long the options, we're actually going short the options. We're writing the contract and selling it for the premium that we can receive, or whatever the market price is for that option at that point in time. So we're going short the call option. We are not going long, we're going short. We're selling it short, so to speak, and we're hoping that the option will expire worthless by the time you get to the expiration date. In other words, we're hoping that the strike price will be higher than the underlying price of the security. One of the most important concepts to understand in selling options or going short options is the concept of theta. Now, I mentioned earlier that theta is equivalent to time value. Okay, so the most important thing for you to understand is that theta, or the time value of an option, declines over time. Here you can see that the slope of the line of the theta decay increases as you get closer and closer to the expiration date. What I like to do when I'm selling calls or puts or whatever I'm selling, when I'm selling them, whether they're covered or naked, is I like to use the time period where the slope begins to increase in the decay of theta. And you can see 60 days, 60 to 58 days is really the optimal. It's when the decay in theta really begins to accelerate. And you can see on this chart, when you get to 30 days, it really starts to decay very rapidly. By the time you get to the expiration date, the theta value is 0. So the components of value that you look at when you're selling calls is you try to pick a strike price that gives you a decent premium, in other words, a decent amount of money up front for the options that you're selling, but at the same time, the term of the option, or the time period from today to the expiration date, is not too much longer than 60 days. Sometimes to get a little bit more premium, you can go a little bit farther out. And the example that I'm going to show you in a minute, we are going a little bit farther out simply because the implied volatility right now in the market is relatively low. So we have to go a little bit farther out to get the same amount of premium. But in general, I think as a benchmark, you want to stick around that 58 to 60 day time frame so that you get the maximum decrease in the theta while you're in the trade. Another concept I want to bring in here is the difference between American style options and European style options. The call options we're talking about in this video are American style expiration, which means that those options can be assigned at any time during the options period. The other kind of option settlement is European, which can only be settled at the expiration. Okay? It sounds like American options are more risky, but they're really not, because it is very rare, and I have never heard of anyone getting assigned prior to expiration, even with American options. And that's because the reason people own options is for the leverage, and it's more costly to exercise that option before the expiration, so it's rarely done. So I would not worry about that so much in this particular trade. So I think the best thing to do right now is let's go to my trading account, and I'll show you an actual example of where I set up a trade for selling call options. And for this example, we'll use ExxonMobil. Okay, so here we are in my trading account. Here I have Exxon teed up here. And let's go into the options tab. And here are the options that you can buy or sell against Exxon. Let's go out and give us enough time so that we have enough theta or time value to short here. Let's go out to September 15th. Now that's going out a little bit farther than the 60 days that I told you about. I think we have 71 days on this, but I'm using this because I want to get a decent amount of premium out of it, so I'm going a little bit farther out. But if you look at this, you can see the various strike prices here. The strike prices are in the center here. Currently the stock's selling for a little over 103. If we look down here at the strike prices, we see we're probably going to want to look at either 110 or 115. Let's first take a look at 110, and we can see that the last price on that was 182. So let's take a look at the details. Here you can see basically what we have here. Last price was 182. Opened at 147, 176. Open interest, this is something to look at. You want a fairly liquid security. 3,800 is a good amount of open interest. That's the number of contracts that are being traded. It's an equity option, and the expiration date is 9/15/2023. American style settlement, which we talked about. And each contract equals 100 shares of underlying security, okay? So we're looking at this one. This is a potential, and we'll also look at 115, okay? Now we're going to go to the Options Analyzer tab and take a look at the probability of this trade working out for us. All online brokerages have this kind of a Options Analyzer tab. I am using E-Trade. That's what I've used for many years. There's a lot of great platforms out there. They're all good. They all have this thing. So this is what I'm showing you here. You'll find a similar Options Analyzer in all of these online brokerage accounts, okay? So here, what we want to do is we want to select a strategy, call, and then we're going to sell to open, and I'm going to do 10 contracts, so that would represent 1,000 shares. And you may say, wow, 1,000 shares, that's insane. That's a lot of money. That's over $100,000 of underlying securities. The concepts I'm telling you about here, you can divide it up, and you can do one contract if you want, but I'm doing 10 here just for illustration purposes. And then we put the strike price at what we looked at earlier, which is, let's try 110 first, okay? And the time period is September 15th. And here's the bid and ask. That's what it's offered at. And that's where the bid is, rather, and this is where it's offered at. So let's hit analyze and see what we come up with here. I'm going to move this to 110, and it's going to recalculate. And what we're looking for here is, what is the probability that this trade will be profitable in that the option will expire below the 110. And you can see here in this example, this trade has a 71.28 probability of expiring worthless, okay? Will close below 110 on September 15th, 2023. Now, let's take a look at this chart a little bit. This price is less than one standard deviation from the current price. If I move this to approximately 115, that's one standard deviation from the current price, our probability of return goes up to 83.56%. Now, these percentages are calculated based on the Black-Scholes theory of options pricing, which we're not going to get into here. This is just a guide. It's not absolute, but it shows you, it gives you a sense of probabilities of doing this trade and having the option expire worthless so that you can keep the full premium, okay? So if we go back to where things are priced out, or if we look at where things are priced out, at 110, we could, based on the last sale, we could make $1,800 on this trade, but there's a higher probability that the shares might be called away at 110, okay? If we put 115 in, you get less money At the ask, you'd get $860. There's a higher probability that you're going to be right and not have your shares called away. Now let's just take a quick look at standard deviation, because if you're going to be trading options, whether you're buying or selling them, you really have to understand standard deviation. So standard deviation is a method of calculating probabilities. When you're selling options, you want to keep very close attention to standard deviation. When I'm selling calls, I want to be as close to this one standard deviation as possible, because it's going to give me a higher probability of success. When I'm selling naked calls as opposed to covered calls, I'd probably want to be in the same range. But if I'm selling naked puts, I want to be closer to 2 standard deviations. Okay? We're not talking about puts in this video, but if you're selling naked options, you want to be farther out on the standard deviation curve, so that there is a very, very low probability that you're ever going to be assigned. Okay? Whenever you're selling calls or puts, in the case of what we're doing here, selling covered calls, you do not want to get assigned, but you have to be okay with getting assigned and selling at that price. So there's really 2 things that you want to be comfortable with before you sell these calls. One is you want to be comfortable with the probability that you're going to be correct in the trade, like we did in the 2 examples. In that example, it ranged from 71% to 83% with the higher strike price. But the higher in probability that you go, the less money you're going to be receiving up front. So you want to be comfortable with 2 things: the amount of money you're receiving and the probability that your shares will be called away from you. Now, what I always like to do is, let's say I'm setting the strike price at 115. I always say to myself, as a worst case scenario, the shares are going to get called away from me and I'm going to have to sell them at 115. Okay? That's the worst case scenario. In the case of Exxon, in my case, my cost basis is so much lower than that. It's not the worst thing in the world to have happen, to get the shares called away, but I don't want that to happen. So I might go with the lower premium in order to be more comfortable that that strike price will not be hit at expiration. Okay, so let's briefly review what we have here on this example that I used, selling calls against Exxon as an example. You can do this against any stock. And, you know, the more risky and volatile a stock is, like if you picked a very volatile tech stock, the premiums are going to be higher than something that doesn't move as much like Exxon. So that's also important to note. But in the case of the 110 strike price, we had a premium that we could have collected of around $860 for that 71-day period. And in the case of the lower strike price with the lower probability of success, we could get a higher premium of over $1,800. So this is what you need to look at. This is what you need to weigh. I would say the first time you do this, pick a higher probability trade so that you can be pretty sure that your shares won't get called away. And you can just do this on a rolling period. And of course, watch that VIX. The VIX is a measure of implied volatility. And the higher the VIX, the higher the option premiums will be, and the more attractive this will be from a return standpoint. Now, in the case of my Exxon shares, Exxon's currently yielding around 3.5%. If you did this for this 71-day period, that's less than 90 days, which is the quarterly dividend, you're going to be more than doubling the dividend return on those shares while you own those shares. So this can be a very attractive, very lucrative thing to do in your portfolio, leveraging off your portfolio. You don't have to sell the shares. You can hold the shares if they're long-term holds, and you can just sell these covered calls in like a program off of your existing securities. It's a very, very smart way, a very conservative way to sell options and to supercharge your portfolio. Well, I hope you enjoyed this video, and if you did, please subscribe and like. I'd love to have you on board as a subscriber for future videos. And if you want to learn more about the subject of selling options, check out this video, which I did a while ago, which goes into a lot more detail about selling options and selling naked options, which is a more risky strategy, but you can also make a lot of money doing that if you know what you're doing. And this video will set you up and put you on your way to be able to do just that. Okay, so thanks for watching, and I'll see you on the next video.